Dahl and Hall, welcome to the show. Jill, I'll start with you. We've had a number of guests who have come on throughout the morning and really just in recent days suggesting that perhaps we've got further to fall when you look at something like the S&P, at least in the near term. How do you see the market right now, given all the different dynamics at play?
Yeah, thanks for having me, Morgan. And I do think that the volatility may not be over. So typically when you see regime leadership shifts in the market, this typically leads to a lot of volatility. We've seen multiple shifts within the market right now, going from Fed and zero interest rate policy to tightening. We're seeing, globalization to deglobalization. We're seeing a lot of regime shifts within the market. So we do expect that it could continue to be a volatile year. That said, obviously valuations have grown, more attractive. And as the market has sold off, we are looking for upside to equities through year end. So we're looking for 4,500 on the S&P 500. The yield curve also tends to be a pretty good long lead signal of the VIX. So, the flattening and inverted yield curve also suggesting volatility could be here to stay. So, we are looking for upside, but, given some back of the envelope math, the market could be pricing in, we think, about a 40% chance of recession based on how much it's declined so far relative to how much it typically declines. So, our base case is that the risks have risen, but we're still expecting no recession next year, still a positive year for GDP growth. But obviously, if those recession probabilities rise, could be more downside risk to equities.
Okay. Bob, I'll put the same question to you, especially given the fact that we have seen these incredible gyrations and moves in the bond market even before we started to see this much broader, starker downdraft in equities.
So I would say that what Art Cashin had just said earlier, I would hang my hat on too. The technicals in these big sell-offs are hugely important. The fundamentals will come around at some point, but until we have a bigger new low list, an increase in the VIX, more stocks below their moving averages, it's hard to have a durable or even a tradable bottom. Our guess is stocks will have a down year, but close higher than where we are. For that to happen, we need not to have a recession. We need earnings growth to remain reasonably good. And we need inflation to peak sometime this quarter, albeit not fall back to tolerable levels. So we're still in shaky territory. We're going to frustrate the bulls and the bears with lots of volatility in both directions, Morgan.
Yeah. Hey, Jill, bulls, speaking of the bulls, they've been counting on at least an inline CPI print for weeks now. I wonder if you think the power of a print that matches expectations has lost some steam, or would it still give us something that's tradable on the upside?
I mean, I think inflation's been obviously continuing to surprise to the upside. We are expecting that inflation should peak out and decelerate through year end. I think this earnings season, we've seen that companies have, to some extent continued to have some pricing power. But obviously there are only so many times that companies can raise prices. So we've been, concerned about margin risks for corporations, especially the more labor intensive areas of the market. Consensus, that's one of the reasons we've been below consensus expectations on our earnings outlook. Just given that consensus in many areas has been expecting margins to reach, new highs in subsequent quarters. I think inflation is still a big concern. And if we get confirmation that we do see decelerating trends in the inflation backdrop, that could be some comfort to the market. And that is our base case for this year.